Well, hope you're having a good morning so far. It's 9 a.m. and we are heading into the pre-opening rates. It's all over the place for now, so we'll wait by for these rates to adjust. Amisha Vora of Prabhudas Leeladhar has been sitting by with us patiently. Amisha, it's very earnings heavy the next few days. You have Reliance today, and there are three big banks over the next 4 days. There's ICICI and Kotak Mahindra tomorrow, and there's Axis Bank on Monday. What's your pick of the pack?
I think Kotak Mahindra Bank could be a surprise winner from the results perspective and otherwise. Because I think last quarter, if you see, CD ratio helped a lot in terms of NIM improvement of ICICI Bank. And this quarter, to replicate that would be a bit of a challenge. Axis Bank, yes, is amongst one of our private sector top pick. But looking at the overall outlook in terms of both the bond yields as well as the credit and asset quality outlook, I still feel that after a good amount of underperformance or stagnation, Kotak Bank from here on can pick up.
Okay, all right. Amisha, before we let you go, I needed your view on HUL and Polycab. Both of them, the cables business did very, very well. And that's what, resulted in a beat for both these two. How are you reading them?
So cable business both did very well, both in terms of volume as well as in terms of margins. So like cables, pipes, a lot of these businesses are doing very well on the back of the infrastructure spend, which is very sustained throughout this period, as also the real estate side, which is doing very well, and PLI investments. So I definitely read that the consumer side of the business have faced the volume or growth challenges. The non-consumer side businesses across have done very well, and that's where Polycab also stood to benefit a lot. And we continue to feel that both these, Havells in particular, because Lloyd's losses are also gradually coming down and they are in the right direction. So it could be a good place to watch and remain invested for some time.
All right, fair enough. Amisha, thank you very much for joining us. Good speaking with you, and thank you indeed for being here on the program, as always. I hope to see you more often. Shirish Pardeshi is FMCG analyst at Centrum. He's joining us right now to take some questions. And of course, I mean, the big one is a lever, right? HUL. Shirish, how would you view this increase? In terms of earnings downgrades, it's not much, right? 2-3%, that's about it. Would you, I mean, as I was saying, you can look at it and say, well, now this is done. For the next 4-5 years, nothing changes. Or does this raise fear that there could be more changes down the line? How would you see it?
Good morning, Prashant. Thank you for having me on the show. Two things. I think one clearly states here, and management did confirm that yesterday, that India is one of the top 3 key markets for Unilever parent. Now, in the context of rising the royalties, I think one has to keep in mind the explanation provided by the management is saying that if you break up that royalty, 1.9% is basically from the brands what Unilever has put it in India, and the balance is coming from the shared services. So though it is front-ended, and I think that's where concerns has been raised, and maybe because of that there is some earning downgrades. But we have to also keep in mind the delivery in terms of the quarter which has gone by, and look at the growth what company has reported in the detergent business. So 32% growth on a YY basis is a humongous growth. And somewhere we need to give this credit to the management capability to deliver this kind of growth in such a tight environment. The second point which I've said, that Unilever has a very strong growth framework. And if I use the example, they have used this WIMI strategy, winning in many India. And over the last 4-5 years, they have been able to trade up the consumer. And I think somewhat we might want to relate it as a premiumization story, but there is a humongous work which is there. And these all things justifies that the kind of royalty the parent is warranting at this point of time.
Okay. I wanted your thoughts also on Asian Paints. Now, there are multiple headwinds playing out here, right, Shirish? On one hand, the management themselves are cautiously optimistic about demand picking up. There was no volume growth this time around, and there is intense competition in this space as well. If you are a long-term shareholder here, would you churn out?
Good morning, Sonia. I do share your concern at this point of time. But when you actually do the deep dive thoughts, I think Q3 is a very big quarter for most of the discretionary spends which is happening, starting from your wedding season, your festive season, and these all things which has happened. But you will also need to observe that and draw your attention, saying that this time, almost till 15th to 20th of October, we had rains in the country. And if you stretch your thoughts, maybe UP, Bihar also had the prolonged rains and we had floods. So this is an impact. While I would say on the other side, when you look at the management did confirm that in the month of December, they have seen a strong double-digit growth. So I think, yes, we being analysts on the street, we will look at the short term. But when you look at the long term, I think the growth fundamentals are very intact. The other attention I would draw, and I would be betting big, and I will not churn the stock at this price. Rather, on correction, I would add. The prime reason is that if you look at the history of last 20, 25 years for Asian Paint smartly ahead of the demand capacity has increased at least 2 to 3 years in advance. Now, yesterday also, Mr. Amit Sengel confirmed that they are putting another greenfield plant, spending another 2,000 crore for the water-based paint. Now, that capacity, when you see that, I think gives the confidence that management knows what they are churning and what they are trying to deliver.
Okay, so if you want to just wrap it up for us, Shirish, what would your top picks be in this space, considering that there's quite a bit of, there's this sort of cloud of caution amongst most of the companies. What would you buy? What would you avoid in the universe that you track?
I think given a merit, yesterday what HUL management and did, even Amit Sengel confirmed that rural demand is going to come back. And I think there are some green shoots, both the management has confirmed. While when you look at the high frequency data and looking back, the macro headwinds, which is going away, the good news is that the inflation is coming under control. And I think that's where I would bet, I would put my money behind high growth rural companies. That's one part. Second, directionally, what we have seen and given to understand, the packaged food and food companies are going to deliver very strong growth. So I would bet on the food companies higher, while the BPC and personal care growth is little away. But going by the seasonality change and the prolonged winter, I would still say that the BPC can play in a medium to short term.
Okay, all right. Thanks a lot for joining in, and have a great day. By the way, a couple of stocks that I want to mention in pre-opening. Just take a look at HUL. It's now down quite a bit, actually. It's down almost 3%, I think, in pre-opening. So I think the royalty issue for the next 5 years is something that the street definitely does not like. So HUL is under quite a bit of pressure, 4% lower now. A couple of other stocks. By the way, gold is at a fresh high, so don't lose sight of what's happening in the commodity market. 58,330 on gold, and it's moved from 51,000 in, I think, October, all the way to about 58,000. So big moves coming in the commodity market as well. We'll talk about that. Mitesh is with us. Mitesh, what's the big call at 9:10?
Yeah, I'll go with the buy on Exide. That's a stock which is looking very positive. Keep a stop at 185. Look for targets of 200.
All right, fair enough. By the way, let's have HUL up. Mitesh, thanks for that. We'll come back to that. I mean, it's opening at an interesting, we don't have the chart to show it, but it's opening at an interesting level. And I suspect if these levels hold, they could be buying at some point during the day and sharp buying, sharp bounce. I mean, possible. This royalty issue, sure. I mean, it does royal sentiment, but there is support. I mean, actually, it's already broken below the levels that I am watching, which is around, I think, 25.80, 25.85 or so. So you're opening at 25.50, and this perhaps could be the low for the day. So let's see. I mean, if it opens here, what happens? The other one is, again, we're sticking with the consumer space. It's Asian Paints that I want to sort of put out. And here we have a chart on Market Laser. This is, again, I mean, it's a pattern we've observed on stock after stock, right? I put out a similar chart, actually similar price points on LTT is completely different a couple of days back. There's been a big break since. Look at Asian Paints. This is, from the lows of March of 2020. That is when Asian Paints made a low. Price was around 1450 or so. It kind of traded above that level for the next couple of years, 2 years or so. There was a touch point in June of 2022 when the entire market sold off very aggressively. This trend line was tested, and only yesterday, for the first time, it has meaningfully cracked below it. I mean, actually, the break below and the close below happened on the 12th of January, but then it was middling through. It was actually coming up closer to this trend line. Post, I think, the numbers, etc. Yesterday's bar conclusively kind of sees a break under it and a close under it. So maybe there is more to go here. As the topic band says, Asian Paints perhaps needs a new coat of paint. We'll see some repair needed here, like a lot of other charts we've highlighted over the last many sessions or so. The other stocks which are moving very sharply, of course, are the metal stocks, Vedanta and Hindustan Zinc. And we've been discussing this, both going in opposite directions as expected, Nigel.
Well, that's right. I would be surprised actually if Hindustan Zinc held on, because the float in the market's only 2 to 3% odd. But Hindustan Zinc is under pressure. There are a couple of factors that played out. Results were in line. They declared a dividend of close to around 13 rupees, which works out to around 49 rupees 50 paise for the year itself. So that was the only piece of good news. Then Vedanta is going to be, selling its Zinc international business to Hindustan Zinc for close to $3 billion. Out of that, 80% comes, the minute it's approved. Valuation-wise, well, it's going to be done at around 10 times EV per EBITDA, which is very high. Hindustan Zinc has net cash of around 12,000 crores. All of them will go into this, acquisition. And it's a related party transaction, so it explains why Hindustan Zinc is under pressure. It's good for Vedanta. They're going to be getting dividend, close to around 3,500 crores odd. They're also going to be getting close to around $3 billion for that international zinc asset, so good news for them. And also, in addition to this, Hindustan Zinc from now on will be paying 2% as a brand fee to the promoter entity. So Vedanta gets some more money. CLSA, they have an underperformed rating, target price of around 295. That's on Vedanta. While Investec as well as Nuvama, both of them have downgraded the stock, that is Hindustan Zinc. Explain why that stock is under pressure, down 8%.
Okay, big moves coming in on the downside for Hindustan Zinc. By the way, ICICI Bank, ahead of its numbers tomorrow, is in the green right now, so do keep an eye out on that. And a couple of other stocks. Asian Paints is under pressure ever since the commentary came in from the management yesterday. Emphasis is under pressure post their numbers as well. Rima's joining in. She has L&T Tech on her radar. Rima, over to you.
Thanks so much for that. So L&T Tech is a miss. The top line growth has been absolutely flat. The management indicated this is on account of higher than expected furloughs in plant engineering, continued weakness in telecom high-tech vertical, and a push out of spend in the medical devices verticals. The guidance for the full year has been cut. Earlier guidance 15.5 to 16.5%. The new guidance is at 15%. So big cut seen in the full year guidance as well. Margins have expanded to record high levels, so that's a positive in Q3. But remember, recently the company did an acquisition of Smart World Cities. Now, Smart World City has lower margins than L&T Tech. So once the integration takes place, there will be a margin impact on L&T Tech, and that the company has quantified as 180 to 200 basis points in Q1 FY24. Also, the stock is trading expensive at 27-28 times forward multiple. Morgan Stanley lowers the target price to 31.50. CLSA sell call, target price lower to 3,200.
Okay, thanks a lot for that. Well, we're just heading into the opening rates in less than a minute from now. As we were saying, it's a very, very quiet and flat opening that we're expecting today, largely because on one hand, you have weak global cues, which are putting a lid on the market gains. And on the other hand, the domestic cues are not too bad. However, a couple of points to note. The entire consumption space could be under pressure today. HUL is down 4%. Asian Paints is down 0.6%. Britannia, the commentary and the earnings have been subpar. And that's really showing up in the stock prices as well. On the upside, though, ICICI Bank ahead of its numbers tomorrow. Kotak Bank also comes out with numbers tomorrow. So those two stocks are looking pretty decent this morning. That's the first tick on the index. Slightly subdued, down about 20 odd points. Nothing surprising, really. Nifty just gravitating around that 18,100 mark. The Bank Nifty is doing quite well. So that's up about 150 odd points. IndusInd Bank is your big mover, posts its numbers up about 1%. ICICI Bank is up 1%. Tata Motors as well is in focus. There are reports indicating that Tata Motors is seeking a $600 million valuation for its electric vehicle business. So it has, it's tapping the street now to do funding for its EV business. So ahead of that, the stock is up about 1%. SBI, L&T are a couple of other heavyweights that are holding forth this morning. You have IT stocks are not doing too badly. Wipro is in the green, a couple of others as well. HCL Tech is in the green, holding up there. So what's dragging the market and preventing it from getting above 18,100? HUL, clearly. So 2.5% lower on HUL. That royalty has not gone down well with the street. Asian Paints under pressure. The management commentary was slightly cautious as well. Sun Pharma is down about 1%. And all consumption names, ITC, Britannia and Nestle, are all topping the charts on the losing end. Titan, after the downgrade yesterday, is also under pressure. Reliance, ahead of its numbers, is slightly subdued. As we were telling you, the consumer-facing businesses, both Jio and retail, have seen a moderation in growth, and that is something that, perhaps is keeping the stock a bit subdued as well. SBI Life, Maruti Suzuki, UPL and Tata Consumer, a couple of other stocks that are trading in the red. So very, very quiet market, just consolidating around that 18,100 mark. But I guess lots playing out in the broader market.
Well, that's right, Sonia. A lot of stocks that are moving around. Let's start off with the IT pack. Coforge, they've gone ahead and raised their guidance. So that stock has opened up the gain of around 3%. Emphasis under some pressure because they delivered a revenue degrowth on a sequential basis. So that's down closer to around 2%. You have LTTS. Well, the revenue growth was below estimates. They also went ahead and trimmed their guidance. So let's get some of these stocks actually up for you. LTTS, well, that stock as well is under some pressure. A couple of other notable stocks. You have Hindustan Zinc, as we pointed out, not a great deal at all for them. Very limited float in the market. So when the stock goes up, it goes up one way. Last few days, I think the stock was up 14-15%. Also, it's giving up close to around 7% of those gains. So that stock under some pressure in today's trading session. Surya Roshni, they bagged an order of around 150 crores from GAIL. So for starters, that opened up in the green. PVR, well, the street has read these numbers positively. There were some, earnings estimate cuts as well. The occupancy levels are still not as much as it was pre-COVID. But for the time being, the street says that maybe in the coming quarter, things will look up. So that one is up close to around 1.5%. Thumbs up on that one.
All right, the market's absolutely flat. I mean, HUL is seen a decent bounce. I mean, the low was 25.36 on a lever. It then bounced all the way to 25.86. It's somewhere in the middle now, 25.70, 3% lower on HUL. What else are we seeing? Market breadth is positive, almost full 2:1. Coforge is up a full 5%. So that's strong, 41.67 on Coforge. Adani Green starts about 2.5% higher. So that's at about 2002, 2003. PVR starts 1% higher. So PVR, by the way, has seen I think it opened at 17.10 and then it's come off a little bit, but still in the green. So it's come off from the highs of the day. Campus Footwear, now actively traded name, that's a full 4.5% higher. So that's at about 411. India Mart, we highlighted earlier. It's a 3% pop on it, but volumes are very, very low. I mean, I go down the list, so I don't want to do that. Volumes are still low. HUL and Asian Paints, well advertised. I mean, I don't think there's any doubt there. Sun Pharma is down about 1%, news flow related. And of course, there is Hindustan Zinc. Havells and LTTS are the two other names which are reacting on the downside on the back of earnings. Some of these high P consumer names like Titan, Nestle are some of the others which are down 1%, 1.5% in that range. ICICI Lombard, I mean, it's having a terrible week after numbers earlier. And that continues to be down and out. It's down 8% Friday till now. I mean, last Friday till date. So that's the picture for the market. 12 points lower is what we have on the index. Our market master of the day is Kenneth Andrade, founder and CEO, Old Bridge Capital Management. Kenneth, great to have you with us here. Thank you very much. And first up, congratulations from all of us here for the mutual fund license.
Thank you. Thanks, Prashant. It's a long way off. We just got a in principle. That's about it.
But yeah, I mean, it's on track, right? So that's great news. What's the view on the market? And I mean, from the last time we spoke about, have things changed substantially? Has your view changed substantially? Or is it still largely, the same, that it's going to be a bit of a muddle through, at least in the first half of this year?
Well, it's a nice year for investors. Why I say it's a nice year for investors, because after a long time you're getting yields at this level. So it's less to do with equity, more to do with fixed income at this point in time. And I think that's going to be a challenge for the equity markets. My sense is that the yields are attractive enough to divert a significant amount of capital that is coming into the equity market back into fixed income, and that should sustain itself for a better part of this year. So equity as an asset class will have competition. If I just correlate what's happening in that part of the world, I think with every increase in interest rates or yields going up, valuations have to come down. So I think that's what the churn is happening in. That's the churn that's happening within the environment itself. Higher yields, lower price earning multiples, and if that's going to be the case, I think that dictates the course for 2023 and for a change for a better part of the decade.
By the way, I just wanted to spot a couple of stocks, draw your attention to some big movers in trade this morning. One of them is India Mart. We were talking about that, how the numbers are quite good. In fact, the stock is up 4%. It's a handsome 34% revenue growth that India Mart has seen this time, and profits are up 60%. And the other one that's just taking it away now is Coforge. The company has gone ahead and raised its guidance for the full year, and it's a very strong constant currency guidance that Coforge has put out. It's in fact taking a lot of the mid-cap IT stocks with it. Kenneth, good morning and thanks for joining in. Yeah, that was my question to you. Amidst all the talks of a slowdown and clients delaying their decision-making, etc., some of the mid-cap IT companies have done pretty well, whether it's Coforge, Persistent, Cyient had a great showing as well. Would you raise your allocation to this space now?
Actually, within IT, our preference is quite obviously the larger caps, because they are available at great valuations. They have got robust business models, and their visibility as far as volumes and contract signing is already there. I mean, most of these businesses are trading at, say, between 3% and 5% of dividend yields also. So if I had to allocate capital, I think bulk of that is essentially into a large cap IT. Mid cap IT, I mean, it's a mixed bag. It depends upon which business is in which vertical and how that vertical is getting executed. So there, I think it will be split wide open in the middle. You will have a couple of good gainers and some of them who flaw on execution, and it's and extremely highly valued. I think you will see a correction in some part of that.
Hi, Mr. Andrade. Good morning. Nigel on this side. So what about these new age themes? You know, some on the street suddenly started taking contra calls. At one point of time, they were totally shunned away. Have you looked into them? Any of them? The Zomatos, Nykaa, Paytm, to name a few?
So Nigel, if I just step back into the experience I've had over the last couple of decades or last 2 decades, there will always be a bounce in some of these names that will come through. I mean, you remember the infrastructure cycle that we had. 2008 to 2012, you had all the large names actually bounce back. Some of them don't exist today. So it's very relevant that we get them at a great price. Okay, execution is pricing is in our favor, and execution is left to the management to actually deliver a solid business model. Now, there are a lot of solid business models out there. The only challenge with an investor like us is that we try to grapple with valuations. For us, valuations necessarily has to be cash flow, necessarily needs to be cash flow, a great earnings trajectory, and most importantly, a very stable management profile taking the business through the cycle. So some of them have it, most of them don't. So I just step back and I just watch the space for a little while till valuations come into our favor, and then probably execute. I would not be worried with any of these companies bouncing or giving you a retraction. They are not on our radar at this point in time.
Kenneth, you know, your long-running bet has been on agri-commodity businesses, right? You mentioned that last time we spoke as well. Has your conviction strengthened, or has anything changed there? Any movement? I mean, you've liked names like Coromandel, Kaveri, Chambal. Go on.
So, I mean, whether it's agri-commodities or whether it's the commodity basket, I still favor a significant part of that those verticals out there. A simple thing has happened over the last decade and a half, right? You've got fewer names entering into that industry. You've got the marketplace very consolidated. I mean, you can take steel, you can take aluminium, you can take fertilizers, you can take seeds. There's no new entrant or new substantially large entrant into that space. And when you have a consolidating market, and when what we see and what we hear is a significant global capex across the entire world, not just in India but across the world, which is upcoming. I think we're definitely looking at a reasonably good trajectory of earnings from a lot of these companies. Now that's the earnings part of it, and that's the visibility part of it. Not all of them are even priced in for a change in trajectory. Most of them are available at equivalents of between 10 times and 15 times earnings, and some of them are even lower. And that's my argument. I mean, their earnings yield is very competitive compared to the bond yields, and that's where we try to find a lot of value that's sitting out there.
Okay. Kenneth, any thoughts on the earnings season as it is panning out? There are at the margin, I mean, there are people pointing out to the fact that things maybe at the margin are slowing down. Consumption, basically, right? Not particularly, may not have an impact on the names that you own directly. But is that a sense that you get looking at numbers?
Well, look at what happened in the last 6 months, right? In the last 6 months, everyone got spooked with inflation, or all of last year got spooked with inflation. Interest rates went up, there was disruption in supply chain, consumption had to fall. And we are going through this entire cycle again. And you will probably have a reversal of what we saw in the last year, in the first 6 months or the first 9 months, as as the macro environment tries to stabilize demand, which is equivalent to consumption. So somewhere we will plateau out in terms of the negativism that you will see in this quarter. But it's a long grind for some of these consumer businesses to come back. They are struggling with valuations and they are struggling with growth. My sense is if you get inflation coming back anytime during this decade, which we think will happen, then it's not a story that we'll back with the capital that we have. Okay.
All right.
So consumer businesses,
please complete.
Yeah. So consumer businesses, we'll keep it on the back burner for now, and we'll just look at them on a company specific basis rather than as a category.
All right, we will leave it at that. Kenneth, have a great 2023, and thank you for your thoughts and speaking to CNBC-TV18. By the way, for the market, it is very quiet, so there's no real update except that the Bank Nifty is outperforming this morning. It's putting up a good show, up almost about 200 points. RBL Bank and Punjab National Bank are front and center in terms of the big gainers this morning. Both of them in the broader markets, that is. RBL, Punjab National, Canara Bank are all moving with some strength. And from the frontliners, it's SBI and HDFC Bank that are doing well. So that is the leader of the market up until now. Let's talk about PVR now. PVR posted numbers that were better than what the street was estimating. Revenue growth was up over 50% compared to last year. Margins also expanded. But of course, last year is not comparable. It was a complete washout for them. Average ticket prices have risen about 16%. The company has also added 20 screens in the quarter gone by, but occupancy has slipped to 29% versus 33%. Nitin Sood, the CFO of PVR, joins us now to talk about that. Nitin, good morning and thanks for joining in. Of course, that's the overarching theme, right? Whether consumer preferences have changed, people prefer to sit at home and consume on the OTT platforms rather than theatres. But I'll come to that in a bit. Before that, just with some brass tacks questions, can you tell us in terms of the merger, how is it progressing? What kind of timelines are we looking at? And what are the immediate synergies that you see once the merger process is complete?
Sure. Good morning, Sonia. So we got the verbal order from the NCLT Mumbai bench on 12th of January. We are waiting for a certified true copy of the order, which is expected anytime in the next couple of weeks. And after that, typically the process of completion of the merger would take about 30 to 40 days, which would involve filing the order copy with the ROC, setting a record date for issue of PVR shares to INOX shareholders. And that whole process we expect to complete in the next 45 days from the date of receipt of the order. So well on track based on the guidance that we had given. This should get completed before we close this fiscal year.
And what about the kind of merger synergies that you see immediately in the first year itself?
Yeah, I think we'll have to do detailed operating work. There is going to be a huge amount of complementarity and the network effect given the size and scale of both the organizations. We've started work on that, and I think we see a lot of potential synergies, but I think we'll be able to give a better guidance hopefully in the next quarter after we've done some more detailed work on that.
All right. Hi, Nitin. Good morning. The occupancy levels are still a little lower than pre-COVID. The hope is that Patan comes in and, ramps things up as well. What's your sense in terms of occupancy levels? Can we visit those pre-COVID levels, say in this quarter or the next one, given the kind of content we have lined up?
Yeah, I think there's been a lot of talk this year about, occupancies being low. And I think a lot of it is attributable to underperformance of Hindi film industry, which has done not as great as what it was doing in 2019. But if you look at the macro picture, we did about 22 million footfalls this year, which is a very large number. So I think some of those talks are a bit overblown. And, in our business, some years could get tricky when one of the industry is not done well. In fact, on the positive side, what we've seen is that, in the South India, the films have actually overperformed and the occupancies have moved up. The contribution of some of these regional films in non-traditional markets like North and West has been, outstanding, which means, new sense of admissions. And I think it's a matter of time, looking at the lineup of 2023, that industry is also going to bounce back. I would say we are seeing almost about 85% recovery. If you look at this quarter's admissions and compare it to where we were, pre-pandemic, we're down by about 16%. And I'm sure, some of this recovery will play out in the next financial year as we get a good slate of films from both Hollywood and Bollywood.
All right. No, absolutely. And let's hope that is the case. Nitin, I have two questions. But the first is, good morning, Prashant here. So Kotak recently put out a note and they made the argument, this is their view, that the Bollywood box office weakness is partly structural in nature. They gave various reasons. I don't know if you saw that note. It's interesting. They pointed to poor content quality, fading fan following of top actors. There's this boycott trend and, amplified impact of adverse reviews, which then leads to lower footfalls from day one, as soon as the movie is released. So if we were to take this as is, how does it affect PVR? You think you'll be just fine with South Indian movies and others, with Bollywood not really pulling its weight for some time to come, if that were to be the case?
Sure. So, first of all, let me respond on our circuit. We've got a very well diversified circuit spread all over the country. South India represents almost 1/3 of our cinema circuit. And post-combination, it will be even more diversified. The combined cinema network will be 1650 screens spread over 110 cities. So I think the focus is that we want to diversify so that we can, play multilingual content across the country. I think the narrative is slightly overblown. I somehow don't agree with the analyst's view. But if you look because we look at the data, and when we look at the data, we are not seeing this trend at all, in a lot of markets. And some of the markets like Tamil, Telugu, Kannada has, hit the ball out of the park. The industry has never done so well, given the box office collections. Even films in Marathi and Gujarati in Punjabi film industry have held. So we are not seeing any of that,
Nitin,
playing out.
This is only on the Bollywood, which is the biggest industry. This view is only not for the regional movie industries.
Yes. So, because we are not seeing this happening in any of the other part of the market, we don't see there is any impact on consumption, and consumer behavior at all. So we believe most of this is really content related, and people who want to go out to watch good quality content. And once good quality content bounces back, things will be back to normal. Hollywood this year. Yeah,
Nitin, I take your point. I mean, things change on a dime, right? Last year, things were so different, and this year, consumption patterns have changed. But can you help us with some numbers? Your average ticket prices have gone up quite a bit. It's almost a 16% growth. And now you're sitting on an average ticket price of around 245 rupees. Is there scope to increase it further in the rest of the fiscal?
Yeah, so first of all, I would like to clarify, when people compare the ticket price, you're comparing it to 3 years ago. Now, if you look at our average ticket price growth over a 3-year period, it's been less than 6%, 5.5%, which is true for any single consumer retail business in this country. So, we've put out a 3-year ago benchmark because the industry has been shut for 2.5 years. But if you just look at the inflation in the economy, the growth in minimum wages, the growth in rentals, we are just catching up for inflation. So, we believe the ticket pricing is quite fair and reasonable. And we've said this always over the last decade or so. The ticket pricing will continue to grow with inflation. We don't see that to be any real concern. On average, our average ticket price is 240 rupees. And it varies depending upon time of the day, location, where you're going. And we price ourselves, according to what consumers are willing to pay.
Okay, all right, Nitin. Nitin, a couple of factors on the revenue front itself. Advertising income, it's still 35% away from pre-COVID levels. How do you see this shaping up? Do you think that you'll narrow the gap out there with pre-COVID levels? And also the other one is the other operating income, which includes distribution of movies. Now that's growing at a fast clip, contributing close to 10% of your revenues. What kind of margins you make out here? Because it's contributing on the top line, but I'm not too sure on the margin front. So in both these two aspects, if you could help us.
Sure. No, so advertising income is direct corollary to how the films perform at the box office. Unfortunately, the media narrative this year has been more negative than what's actually playing out on the ground. I think we need a series of films to do consistently well. And we are reasonably confident advertising will bounce back. And next year, should be a big revival in the advertising revenue for the cinema business, also leveraging the synergy from the combined entity operations. On the distribution business, we do a mix of Hollywood as well as Hindi film distribution. This quarter has been quite big for PVR Pictures, where we distributed films like Vikram Vedha and Drishyam, which was quite big for us. We make on an average about 7.5 to 8% gross margins on the films that we distributed. We create a pipe. We don't take a risk on the content or quality or performance. We work on an advanced commission model. But we've created an infrastructure and a pipe which helps us to distribute films across the country, reach out to the farthest corners and every single cinema in this country for a distribution.
I mean, movies are such a emotive subject, right? They bring out such passion, well-argued reasons on both sides. But I mean, I don't think there's anyone who doesn't love movies, and watching it in a great ambience, absolutely. Nitin, you've never put really numbers, and I think my colleague asked you that question. The synergy benefits. Is there any way for you to quantify what could it be with this merger? What's the upside on at an operating level? If you can give us some indication.
See, I wouldn't want to quote a specific number because we're still doing detailed work. But I think broadly we see big synergies in all the revenue lines, especially F&B and advertising, which are two elements we combine. We see great potential to grow those two lines in a significant manner. There would be programming synergies some of our circuits are overlapping. How we program films, how we showcase them will play out and help. And on the cost front, the combination would help us in getting the supply chain benefits on a lot of our cost items. We are building out a very large circuit between PVR and Inox this year. We will be adding approximately 180 to 190 screens. We've given a guidance of 110 screens. Inox is opening about 75 to 80. So that's a large capex as well. So all of these, items will deliver a supply chain benefits given the volume of stuff that we'll be buying, and as we go to more and more cities in this country.
Okay, just two numbers if you can share with us. One on occupancies, right? I mean, you did mention that occupancies were on the lower side because of the weakness that Hindi movies saw at the box office. So what are you expecting in terms of normalized occupancies over the next, say, 3 to 6 months? And what is the content that one can look forward to in terms of, for the rest of the calendar year?
Yeah, I think, Bollywood, a lot of the content that is releasing right now was conceptualized and created pre-pandemic. I think in next 3 to 6 months, we will potentially get over with that. And a lot of the films that will release in the next fiscal would be new films which would have been created in the last 12 months. So we think that content refreshing will play a big role. Secondly, Hollywood, had almost 40% less releases this year. Because no content was created during the pandemic. That is going to sharply bounce back next year, and Hollywood has a big year ahead next year with franchises like Fast and Furious, Mission Impossible, 3 films from the DC universe, 3 films from the Marvel universe. Hindi films are quite strong next calendar year. We're starting with Pathaan, of course, on 25th January, but Shah Rukh has 3 films, in the next financial year after a long time. So that's going to be big. We have 2 films from Ranbir Kapoor, 2 from Ranveer Singh, 2 Salman Khan films. So content pipeline definitely looks very strong for 2023 ahead.
Okay, you got us all excited here in the studio. We have so much to look forward to. Kick-starting with Pathaan, right, that releases later this month. So all eyes will be on that. All the best, Nitin. Thanks a lot for joining in.
Thank you.
All right, that's the word coming in from PVR, but we have a whole host of other guests lined up on the other side. IndiaMart Intermesh is a stock that's surging now, post its numbers. Dinesh Agarwal, the founder and CEO of the company, will discuss their Q3 earnings in a bit. We also have Coforge, which is the biggest mover right now. Sudhir Singh, the executive director and CEO of Coforge, will be joining in for a discussion on their Q3 numbers. So do stay tuned in for that.